now for today's market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Murio, and today we're looking at two events in the next week that could have significant market implications. One is any potential Brexit-related news coming out of the Bank of England this week, and next week, of course, we have the FOMC. We're going to be looking at Euro currency options and NASDAQ NQ options. Joining me is Chief Investment Officer of Kingsway Asset Management, Scott Martin.
Hi, Jim.
Scott, I think I know how you're going to answer this, but which is the bigger deal of those two events?
Well, it may be yours, because the FOMC is certainly the most influential central bank in the world, but there are other central banks out there that are moving currencies, moving indexes just alike. So I think it's one of those things where, yes, the FOMC is front and center, but some of those other central banks are not too far behind.
Okay, the FOMC, we've had two major hurricanes in the last week. The FOMC, do they have to see the economic impact of those before they can tighten? In other words, are they going to take the tightening off the board?
Two terrible disasters that still are on our minds these days. But economically speaking, doesn't it seem a little bit too coddling of the FOMC to be concerned about the near-term impact with respect to the longer-term impact, which ends up being worked out, as we've seen in historical data points?
Yeah, I agree completely, is that generally speaking, on the short term, it has a negative economic impact, and it can be a tailwind in the medium and long term. But I don't think they can take the chance, is what I'm saying, is that they can't tighten now into something that could potentially be a slowdown.
It's potentially true, but then if you look at historical rates, I mean, it's like, when are they going to put a rate hike in there if they don't do it sometime soon?
I think their hands are tied. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we're looking at these now, the NASDAQ is trading 6,000 even in the December contract. Scott?
Sure, and looking at the 60 euro from my trade today, which is trading about $1.19.
Okay.
And I'll tell you what's interesting. I mean, I've been fascinated by some of the pressure, let's say, that's been going on outside of the FOMC, on the Bank of England, on the ECB, because better than expected economic data is coming in, and inflation pressures are starting to heat up.
What's that? What's inflation?
Well,
Anyway,
exactly.
go on.
We don't know what that is in the U.S., but apparently they do overseas. And so specifically, Jim, looking at the 60 euro today, I'm looking at buying the week 1, October, 117.5, 117 even put spread in the 60. It'll cost you about 10 ticks, or about 125 bucks. The current underlying on 60 is 119 even or so. It's going to risk 125 to make a potential 625. It expires on October 6th, so you have a little bit of time for some reaction in the euro to maybe pull back a little bit. I mean, the EU, the 60 has been on fire the last 6 months to a year, so it has to, I believe, retrace some of that, especially if we get a surprise rate hike out of the BOE shortly.
Here's why I really like that trade, and I hope you remember that when I bring my trade out, that I said I really like this trade. And then, because the dollar's been trying to go below this 92 to 90 level in the Dixie, and it hasn't been able to do that at all. It's bounced. I think it's going to be higher in that range. I like this trade a lot. Now, I'm looking at the FOMC. I think it's a bigger deal. I think they're not going to tighten, and I think they're going to signal a more dovish stance, because I think they have to. Now, the reason I'm choosing NASDAQ is because if they signal more dovishness, I think it's going to send a risk-on reverberation through markets. And of course, that's going to affect the S&P, but further out the risk spectrum, where the NASDAQ lies, could be affected more. So I'm looking at buying the week 4 September 60.50, 61.50 call spread for 12 ticks. This expires September 22nd, so a week from Friday, and has decent NASDAQ underlying. Trade risks $240 to make $760. Tell me how much you love it.
I love it.
No.
I'll tell you what's interesting, though. You have a few different ECB, or you've got central bank meetings, ECB we just had, but then you have BOE and you have FOMC, and you have different ways to position it via different expressions and different indexes, which is really cool. And I'll tell you what else is interesting from just the BOE expression is, you look at how the euro trades versus what the BOE's done in the past. That's why when you look across your portfolio, there's a lot of different exposures you can put on for a single event.
Right, last question. Is the Fed going to tighten this year, in your opinion?
I believe there's still one more coming.
I believe they're not anymore. I changed. Thanks for joining us on Market Movers. I'm Jim Murio, where we're helping to make you a better trader.